PayPal stock dropped 3.2% as the stock got a downgrade, while Celsius stock leaped almost 15% in a single day, or even over 22% in the last 3 days. And while initial reports pointed towards Wall Street bets, the Motley Fool, who I'm generally not a fan of, showed us some insight into what may be driving the price increase. Now, SoFi is quite aggressively accelerating the push into credit cards, so I will explain what I think about that. And lastly, Domino's released their earnings, and the stock reacted as meaningless as it possibly could. But as I do find this an interesting stock for the stable part of my portfolio, we will take a look how their earnings compared to what analysts were expecting. Now, if you enjoy my videos and you gain new insights from them, make sure to hit that thumbs up button and subscribe to my channel, as I release new videos every Monday, Wednesday and Friday, in which I go over, earnings, company-specific news from companies within my portfolio, and general opinions on, breaking news from stocks. Now let's not waste too much time and just dive straight into my video, because we have PayPal stock drops, the case for stepping over the sidelines. Now this was an article from Barron's, but what this goes over is the downgrade that Bernstein gave to PayPal stock. And what they said is that analysts led by Harshita Rawat downgraded shares of the payment company to market perform from outperform, but raised their price targets to $80 from $75. PayPal stock fell 3.4% to $78 in Thursday's trading. Okay, so let's just see what I think of this, because it's really interesting that when we see this stock go up like this, we suddenly see a downgrade. Now the article continues saying that the team upgraded the stock in July, citing better product velocity and execution under new management, among other positives, but noted there wasn't upside to the target price thanks to the stock's recent gains. Through Wednesday's close, shares have soared 33% this year, and Barron's recommended the stock in March. Now that said, the stock's path forward is unclear as the company balances challenges including competitive pressures around its branded checkout button and tailwinds from buybacks and monetization efforts, analysts wrote. So what they are saying is that they like the velocity of innovation and that this was a reason to upgrade the stock in July. And now that they show that they can actually innovate, they show that the innovations are having traction, now they are downgrading it. Okay, that's a bit weird, right? And then since the stock price has gone up 33% this year, they upped their price target by $5. I mean, it's a bit of a strange move in my opinion. But okay, let's continue. Given the wider than usual range of long-term outcomes for this company, we are stepping over to the sidelines until we get more visibility. So the company is doing better than it has been doing in the past, certainly 1 year, probably last 2 years. They are finally moving forward again instead of stepping back. And now all of a sudden the future has become more unclear. Now that doesn't make sense to me. That doesn't make sense to me whatsoever. Now, Bernstein presented a series of items to keep an eye on, including the long-term trajectory of the branded checkout button, the ability of new initiatives including Fastlane, a one-click guest checkout system to bolster gross profit growth going forward, and the impact of pricing changes in its unbranding payment business, Braintree. Further, we see some risks of negative revisions on gross profit into 2025 because of exposure into interest rates. Now, the exposure to interest rates, that's an interesting argument actually, because that is true. Now, this is also something PayPal takes into account for their own guidance. This is something they have been quite vocal about, that they have been seeing tailwinds from the interest rates, because they have that balance on there from people that have stored cash on PayPal. They can just use that and use it for short-term treasuries in order to get that interest payments. So that's a valid argument. That's true. However, we have to keep in mind that this is also something that PayPal has been very, very conservative about. They have been holding this into account with their guidance, and they have been saying that the negative effects from interest rates are something to keep in mind. But they have been saying this. This is something that they are thinking about. So having negative revisions into 2025 because of the exposure to interest rates, kind of is a non-item to me, an empty argument. The same goes with the branded checkout button. We simply have seen growth in this. Now, it isn't stellar growth, I'll give them that. But we have seen very stable, continuous growth. So all in all, I don't agree with this downgrade whatsoever. And if we are being honest here, we still have a trailing PE of 19. And we have a forward PE of 17.6. Still very low. In my opinion, that forward PE should still be around the 23 to 25 mark, with how the company is currently doing. Now we can see all of that quite easily here. We have the upcoming earnings report in which we are expecting 98 cents for EPS. Then we have $1.06, $1.08, and $1.16. That are the coming for EPS expectations. So this adds up to $4 and a bit. Now times 23 to 25, we are at around $100, which is my price target currently, or at least what I see as a fair value based on their forward PE for the next 12 months. Now then we should talk about Celsius, because, well, Celsius stock, if we look at the quarter to date, we are suddenly seeing, this might be a bit zoomed in, the year to date, we are suddenly seeing that spike here. The stock is up 22%, slightly over 22% in the past 3 trading days, so this week. And then right now, in pre-market still, we are also up 5%. I mean, this is an absolutely crazy move. So what has happened here? Now what has happened is actually quite easy. Because an article that we saw yesterday from the Monthly Fool said that Piper Sandler released a survey yesterday confirming Celsius' continued popularity amongst teen energy drink consumers. And separately, Stifel reported this morning on a National Association of Convenience Stores trade show, reporting positive sales trends in that market segment. And that market segment being the energy drinks sector. Now, the article continues saying that a double dose of good news for Celsius, with CNBC reported on the Piper News this morning, noting that among energy drink brands favored by teens, Celsius holds a 35% market share. Now, this is really important because those teens will be the future consumers of Celsius. I mean, they just simply keep drinking this stuff, right? So a 35% market share amongst teens is really, really important. Now, that's pretty astounding. The article goes further, because across the entire market, the Statista survey in 2023 found Celsius scoring only in the single digits of market share, while Red Bull and Monster Beverage dominated this market, with market shares of nearly 40 and 30% respectively. So while initially Statista, or a Statista survey, found that Red Bull and Monster Energy absolutely dominated the market, somehow right now, when we switch it into this view, we see somewhat of a different picture. Okay, so albeit the two surveys cover different markets, Celsius' greater popularity amongst the younger contingent suggested Celsius' overall market share will grow as these teenagers age. Now, once again, that's also what I just told you. Meanwhile, Stifel's report shows general improving sales trends for energy drinks sold at convenience stores in 2024, where 62% of all energy drinks sales occur. And I mean, this is quite significant. This is more than quite significant, because now apparently things are not all that terrible for Celsius as they appeared to be. But I do think this is quite a sketchy move within the share price. Now, I must say that once again, things are not as bad as they initially seemed to be. And I mean, the EPS growth for this company is still projected to be absolutely immense. I mean, it's very, very good. Because for fiscal 2025, we still have an estimated 27.5% EPS growth and a 2026 growth of even 30%. So this company will still put up enormous EPS growth numbers, according to analysts. And this is with all the bad news we have been seeing, with Pepsi decreasing their inventory, Pepsi decreasing their buys, of course, or Celsius' sales to Pepsi. I mean, things just are not as bad as they seem to be. Now we also, which was, I think, man, this was right before the really big dump. We have to look at the white line here. I think here, we saw comments saying that convenience store sales were down for Celsius. And this was, well, before the absolute panic of Pepsi buying less inventory from them. Now that story seems to be recovering, just like these stories about the consumers are recovering. So all in all, things don't seem to be as bad as they were initially thought to be. Now, if we look at the numbers, we are still seeing a trailing 12-month PE of 34.3, which is, I mean, for a 27 to 30% EPS growth, I think that's quite good. But if we look at the forward PE of 47, I think that's a bit excessive. Now, I also think this will be adjusted away because this is also keeping in mind the Pepsi slowdown in buys from Celsius. So all in all, I think this will recover and this will end up quite decently. But we are seeing a massive move in the share price here, right? And honestly, I can only say it's somewhat justified for all the people that went through all the difficulties with this company. Now, then we had SoFi, who, well, in my opinion, quite aggressively increased their exposure, or is trying to quite aggressively increase their exposure to the credit card game. And they did this with two new offerings in their portfolio. Now, if we look at the article, we can see a positive news comes from SoFi Technology that just expanded their credit card portfolio with launching the SoFi Everyday Cash Rewards credit card and the SoFi Essential credit card. So the SoFi Everyday Cash Rewards credit card offers 3% unlimited cashbacks on dining out and in, including for delivery services, a 2% unlimited cashback on grocery and convenience store purchases, and a 1% unlimited cashbacks on all the other eligible purchases. So I think that's quite an aggressive rewards program. But we know that SoFi is trying to expand in that credit card segment quite aggressively as well. So kind of fits what they wanted to do. Now, they also say that the SoFi Essentials card is aimed to help build or improve credit scores with no annual fees, over limit, or foreign transaction fees, or any surprise fees. The two offerings will serve their clients' spending and borrowing needs. Now, we know that SoFi is trying to diversify their revenue sources and that they want to grow into the credit card business. Now, we also know that they are willing to take a loss right now in order to see profits from it from the future and to take in those customers first. This is part of their expansion plan. This is what was highlighted by Anthony Noto in their last earnings release. So we know that they are willing to take some hits in it. But I do like that they try to bring in more customers and they want to be, well, somewhat aggressive with it. And I think they also can be. And the reason why I say so is that we are now seeing employment data coming in quite okay, actually. We see a consumer that might not be as stressed as the data initially suggested, with revisions coming in positively for companies. And we see inflation data being quite okay. There is no reason to really cut interest rates, which means the economy is doing quite good. So yeah, that also means that SoFi can expand a bit more aggressively. They have been holding back because, well, they said that markets wanted too much. So overall, I am very much looking forward to the next earnings release, which is scheduled on October 29th. I will be doing a deep dive into my expectations, what analysts are expecting, and what I would like to see from them. And also what I would like to hear from them. But that does mean that I want to take a moment to talk about Domino's. And I haven't really ever talked about Domino's on my channel yet. I mentioned it that their earnings were coming up. But Domino's is a stock that I used to own. But I sold it because I was a bit worried about their leverage ratio. They have a lot of debt. And I mean, with the rising interest rates, which we had, I was a bit worried about how they were going to repay that. Now, they are bringing down that leverage ratio, so that's good. A year ago it was at 5.5, it's now at 4.9. So they are improving on that part. But I'd look at their earnings because they were somewhat a mixed bag. And what I want you to look at initially, or what I want you to look at first, is that revenue number, that sales number adjusted, and how stable that is. Because we see it growing with a few percent per year, a few percent year-over-year growth each and every quarter. But this is their latest quarter, this row, and let me just adjust it so that you can see the expectations beneath it as well. Okay, so when we start out by looking at the revenue, we can see that they had $1.08 billion in revenue, which slightly missed the average analyst estimate. Now, if we then look at the gross profit, we can see a slight miss again because analysts expected 428 million and they delivered 423 million. However, if we then continue to look at their net income, this is what was quite surprising because we had net income of 147 million, while the average estimate was 128 million. So that is really good. They did surprise there. And that's also what we saw in the EPS numbers because we had EPS of $4.19, while the average estimate was for $3.66. So they absolutely beat on the EPS numbers. Now, once again, why do I think this company is interesting? That's because of how stable this business is. Do I think it's a buy right now? Well, maybe not. I'm not quite sure. I will have to dive into it once again a bit more. It is a company that is on my radar because historically speaking, it isn't that expensive. I mean, we can see that right here. We can see a next 12-month PE of 24, while the average is 29. So, I mean, that's quite interesting. It is trading slightly at a lower forward PE ratio than it historically has done. However, they still have that debt load and they will have to refinance that debt. And that may not be in the most ideal conditions. Now, I do have one other thing that I want to ask your opinion about, your advice about. I'm looking to invest a bit into the hardware for my YouTube channel. I want to buy some new equipment. And I'm curious as to what you guys think is the most important part for me to upgrade. Is it the audio? Is it maybe for my screen recordings? Is it the overall just video quality? Let me know what you think is the most important, and you can do so by commenting under this video or sending me a direct message on X or Twitter. I'm curious what you guys think. Now, with that being said, make sure to subscribe to my channel if you haven't done so already and hit the thumbs up button. And I hope to see you in my next video.